This is a debrief of Task 4 from the first sample assessment of business tax. Task 4 is about chargeable gains and allowable losses of companies. Remember that chargeable gains for companies would just be included as part of their corporation tax. So we're told that we need to calculate the chargeable gain to be included in the corporation tax computation of Company B for the year ended 31st of August 2024. Any amounts to be deducted in calculating the gain should be shown as negative numbers using a minus sign. And all entries should be stated to the nearest pound. And you see that the computer has given us a table. We've got the various headings there. So we just need to put our numbers into the box and it will calculate the gain automatically for us. So let's look at the information, and the technique is to work through the text in the scenario line by line, putting the number into our table somewhere. So you can see we've got quite a lot of information in the scenario, but our table is a little bit simpler. So it's going to be easier for us to read the information and then put the number into one of the 5 boxes than it is to start with the table and work our way down. So for example, the first text in the table is proceeds. So, well, where is the proceeds information? Yeah, you could waste a lot of time looking for proceeds. Whereas it's just be easier and quicker to work through the text from top to bottom. So we're told that Company B disposed of a machine during the year ended 31st of August 2024. The machine cost 87,000. Okay, so we should put that, there we are, the cost. So we have a cost of 87,000, so we want to deduct that from our proceeds to work out our gain. But it also tells us this, we have legal fees of 890. So those legal fees are an inherent part of buying that machine, aren't they? If we hadn't paid those legal fees, we wouldn't have the machine. So we're allowed to include those in the cost of buying the machine in the first place. So that means our cost is 87,890. Then in 1st of January 2018, 3,000 was spent on improvements to the machine to make it more efficient. So this is capital expenditure. Yeah, we're making the machine more efficient, we're improving it, so we can include that as enhancement expenditure. So there's another minus 3,000 cost, which we can deduct from our proceeds. And then in December 2020, 800 was spent on replacing a broken switch on the machine. So that is not improving the machine, is it? So for tax purposes, we treat this as a repair, as an expense, and that's not going to be part of our capital gains. So that 800 expense would be deducted from our trading profits rather than included in this calculation. And then Company B sold the machine for 108,000, so that's part of our proceeds, isn't it? That could be a positive number because that's money coming in. And we also incurred legal fees on the sale of 486. So yeah, we've received 108,000, but we immediately pay those legal fees of 486, so we can deduct that from the proceeds. And what else are we told? There's indexation factor from January 13 to December 17 of 0.131. So the idea of this indexation factor is that we bought this asset a number of years ago, but it would have gone up in value because of inflation. So the government allows us to have a smaller gain by inflating the original cost. So we originally paid 87,890. So we can take that figure, 87890, and then if we multiply it by the indexation factor of 0.131, that tells us that we can make an adjustment for inflation of 11,514. So that increases the cost to take into account that there was inflation. But the initial expenditure isn't the only thing, is it? Because we also have the enhancement expenditure of 3,000. So we could also apply the indexation allowance to that 3,000 enhancement expenditure. But notice that the enhancement expenditure was in January 2018. And looking at the indexation factor, it's from January 13 to December 17 because indexation allowance only goes up until December 2017. So as that enhancement expenditure was incurred after December 17, then indexation allowance doesn't apply there. And so we only apply the indexation allowance for the original cost and not the extra £3,000. So our gain calculation, so we've got our proceeds, we take off the selling expenses, we take off the original cost, including any legal costs there as well. We take off any costs that improve the asset, and then we also deduct the indexation allowance based on the original cost and using the indexation factor they gave us in the question. So after all of those deductions, we have a gain of £5,110. So let's move on to part B of the question, which we have some true-false questions. So the first statement, to qualify for rollover relief, both the asset sold and the asset bought must be a building. Well, that is false because the qualifying business assets for rollover relief includes land and buildings which are either occupied and which must be occupied and used for trade purposes, but also includes fixed plant and fixed machinery, ships, aircraft and hovercraft, satellites, space stations and spacecraft, but also goodwill, but only for sole traders and partners, and not goodwill for companies. So it's not just for buildings. Section 8 of the reference materials also helps us with this. So it tells us that the qualifying assets must be used in a trade and be land and buildings or fixed plant and machinery. So it can be more than that, as we just discussed, but it's not just buildings. Then the next statement, to qualify for rollover relief, the new asset must be bought no more than 3 years before the sale of the old asset. So remember, the idea of rollover relief is that when we are stopping some part of our business, we're going to sell the assets and we're going to make a gain on that. But if we use the proceeds from the sale to invest in a new business, it means that we can get relief and we don't have to pay tax on those gains right away. We'll pay tax in the future when we sell the second business. And so this statement is saying that to qualify for the rollover relief, the new replacement asset must be bought no more than 3 years before the sale of the old asset. Well, what do the reference materials tell us? So there is a qualifying time period. So replacement assets must be purchased between 1 year before and 3 years after the sale of the original assets. So that means that the statement is false. And then the third statement, rollover relief is restricted if the asset sold is partially used for non-trade purposes. Again, the reference materials help us here. The qualifying assets must be used in a trade. So that is true. If they're not used in a trade, then it's going to affect the rollover relief.